David, we were speaking a little bit earlier here about brands, right?
Yeah.
And the value of those brands, the equity of those brands, if you will, but more importantly, how an investor, and for that matter, regulators, puts an actual price tag on that.
Yeah, we spend so much time and money on brands, and we say that they're very valuable, but how valuable are they? And how quickly can they be affected? We saw it at the beginning of this week. I mean, so much news this week, Romain, with the Fed and with the numbers about the economy. We forget that Elon Musk decided to change Twitter into X, as we know, whatever that is, the universal app. And there was reports at the time that, in fact, that was going to reduce the value of the company by somewhere between $4 and $20 billion because of the damage done to the brand. Now, I don't know about you, but that's a wide range, $4 to $20 billion.
It's a wide range, but it raises a big question, though, about the value of those brands and why you don't necessarily walk away from them. Now, he may have other motives for why he wants to sort of move to X instead of using the Twitter name. But again, you know, what is that value and why turn your back on it?
Well, and it also points out something. If you have a plant, you know, that can't disappear overnight. You can't just eliminate that with a stroke of a pen. If you have a brand such as Twitter and you say, let's call it X now, you can literally really change the value of that with the stroke of the pen. And that really raises questions for investors, Romain, as you go about investing, or if you're doing a merger and acquisition, what valuation you put on it when in fact it's so intangible.
Back in the 90s, when I kind of, you know, really sort of to kind of dive into this business and learn about accounting and things like that, there was a lot of talk then about how you value intangible assets, if you will. So whether it's the brand name of a company or other sort of intellectual property. And there was a great paper out that it was like Len Nakamura over at the Fed wrote basically kind of a roadmap for this. And the problem, and I think that one of the guests that we were trying to talk to today, is that there really are no clear accounting rules for how you do this. And this is a big part of the reason why you don't see this on company balance sheets.
Because the accounting rules were developed for the manufacturing age, when it was plants and
you needed something you can touch
and you know
feel.
Exactly what the value of that, you can put a valuation on it. But increasingly, as you know so well, Romain, the entire economies have changed. As we've gone into the internet, we've gone into intangibles. And so a lot more of the valuation is in things that you can't put a value on. And what does that mean for investors?
Yeah, and I was looking at Interbrand, which tracks this stuff. I mean, they look at Apple, for example, just the name, that brand name alone. They're saying it's probably worth something like $500 billion alone. That's not, we're not talking about the market cap, we're not talking about the revenue, just the name. Same thing with, you talk about, you mentioned Twitter maybe being 4 to 20. I was looking, I think Facebook has something like a brand valuation alone of 40 to $50 billion. And you have companies like Coca-Cola, which of course are iconic, McDonald's, things like that, that to a certain extent, even if the business suffered, that brand would live on.
Well, and Romain, you know so well, you know longer than I have, that ultimately that valuation is a question of discounting future cash flows.
Yes.
And so when you say, okay, if you had your iPhone, but it wasn't called an Apple, it was called something else, what would be the value? What would be the diminishment of the money you'd pay to the company for that? I don't know how you figure that out.
I don't, but it has to change, right? Because, I mean, the whole thing that Nakamura was talking about, Ọswosdamodaran, and a lot of these finance experts have talked about is that this has become a much bigger part of our economy, a much bigger part of corporate America, and to just simply ignore it, you can't do that anymore.
It also raises questions from really. So when you look at balance sheets, when you look at things like price to book, what does price to book mean in that world? Does it even mean anything? Are we outmoded in some of the ratios that we use as we really assess these things?
I think we are, and I think you see this a lot when companies do get bought and sold, and that's where the buyers often have to come in and try to make more accurate valuations to make sure that they're getting a fair
But that,
value.
as you know, that's part of the problem, because so much of a balance sheet these days is in the intangible goodwill. Goodwill is just created. You say, I'll pay you 100, but I can only account for 30, so 70 is goodwill. It's just the difference between what I'm paying for it and what I can actually prove its value. So we have no idea what that goodwill is actually worth.
Now, how do you amortize brand valuation, right? I mean, like you said, you mentioned a factory. You know, generally, you can sort of create a model for the depreciation of a physical asset, or the appreciation for that matter. You take it both ways, but how do you do that for a brand?
I must say, I worked for the Walt Disney Company for years, and we used to talk about we used to talk about brand all the time. And the Walt Disney Company invests an enormous amount of money in brand. I was never in one conversation that asked the question, what's the return on that investment? How do we calculate that? We're putting all this money into it. How do we determine what money is well spent for brand and what isn't well spent for brand? How do we connect it up with increased revenues and therefore increased operating income?
And if you ask executives about that, I mean, at least as a journalist, you never really get a straight answer.
But to bring it back to X or Twitter, one of the things that I was wondering about was,
are you on X?
I actually am. I went right on it to figure out what it was and how it worked. But I wondered as it happened, how much of this is Elon Musk deciding actually Elon Musk is the brand, not Twitter? That he'd rather have his brand in there. And what is the Musk brand worth at this point? Probably a fair amount.
That's a good point, and I think with his ego, that you're probably onto something there. And look, and in fairness to him, maybe he can take a simple letter like X and turn it into a proprietary brand that maybe is more valuable than Twitter down the road. But at least in the initial sort of transition here, has a lot of people scratching their heads.
But as you say, Romain, more valuable if he can get more money for the advertising on X, as we now call it, than he otherwise could. And that's the question: is it going to increase the value, even as we see Twitter X is now cutting the price of advertising to try to get advertisers back in? Yeah,
and this is the challenge, though, I mean, for folks on Wall Street when you're trying to value a company, whether it's publicly traded or like X, whether it's private. Here, you have tons of people on Wall Street. This is their job, to sit there, look at these spreadsheets, and try to figure out a way to put a value on that and try to figure out whether that value is going to go up or down.
Which raises a larger question as well. You're exactly right. There are a lot of people on Wall Street whose job is doing that, and they want to make sure they keep doing that job, so they keep generating that. The question is it really worth that much with all those spreadsheets? When you take all the spreadsheets and try to put your brand into it, is it really telling you anything at all?
It's hard to say. And like I said, I mean, Twitter X, it's easy to pick on that because that's kind of, it's easy to pick on Elon Musk these days. But then you go back to Meta's, Facebook's, I should say, transition to Meta. That was really derided at the time. But, at the time, but now you look back and it's just Meta, right? We've all sort of accepted it for what it is.
Well, and given some of the earnings we just saw, some people are suggesting they went to Meta too soon because the thing they're making money off of is actually a good old-fashioned Facebook and the related brands, not Meta. They're not making money off of that yet.
Yeah, there were never any discussions when you were at Disney for them to change their name to W.
Disney?
Yeah.
Oh my goodness.
Did you just pick a letter? No.
No. We never talked about that. Heaven forfend. Jeez, that would be heresy. You'd be kicked out right quick.